Good morning, ladies and gentlemen. Welcome to the Siloam's full year 2024 earnings call webinar. We hope everyone's doing well. I'm Vivian, the Investor Relations of Siloam. And in today's webinar, I'm joined by Bu Caroline Riyadi as Siloam's Managing Director, Pak Daniel Phua as Siloam's CFO, and Pak David Utama as Siloam's President Director. This webinar will be opened by Bu Caroline Riyadi, followed by Pak David Utama for NGS updates, Bu Caroline for business and ESG updates, and lastly, Pak Daniel Phua for financial and operational updates. After the delivery, we will open up the floor for Q&A. Therefore, for participants who want to ask questions, please use the Q&A function in your Zoom screen. Before we start the webinar, let's watch Siloam activity throughout 2024.
And with that, the 2024 season comes to an end. Good night.
And without further ado, I'll pass the floor to Bu Caroline. Please, Bu.
Thank you, Vivian. Good morning, everyone. Welcome to our full year 2024 earnings call. Joining me this morning is David Utama, our President Director, and Mr. Daniel Phua, our CFO. As you can see,
With that,
it was a very busy year for Siloam with many new milestones and achievements, many challenges as well. But most importantly, we are so proud of our team of the 14,000 employees, 3,000 specialist doctors, and thankful for the opportunity of touching the lives of so many patients and families in 2024. So today we're going to do things just a little bit differently. First, I will pass on the mic to David to start with a progress update of our strategy that we have started executing, Next Gen Siloam, and I shared about this in our last earnings call. Then I will continue with a few highlights of our business and operations, and then lastly, we'll bring Daniel on to close with the financials. So David, over to you.
Thank you, Bu Caroline, and good morning to everyone. Thank you for joining the earnings call. I have the privilege to share with you on the strategy of Siloam. This page, if you can move to the next page, describes of the landscape of what Siloam is today. If you look at the bottom part of the chart, which is Siloam 5.0, was the strategy that we have been implementing since 2019 to 2014. Most of you have, if you joined the previous sessions, you were aware that we had 4 pillars under Siloam 5.0 strategy, which is growing the core by fixing through operational excellence and continue to expand on the network. That's why we have moved very rapidly for the past 10 years from 10 to 41 hospital networks, and continue to improve or strengthen our clinical programs to ensure our patient outcome is the best. And we continue to invest or build our digital ecosystem capability. And with Siloam 5.0, if you can see the result that both Ibu Carol and Pak Daniel will share later, have given an outstanding outcome financially and operationally. Then the question that we always ask ourselves has been, should we continue on Siloam 5.0? It's working. It was spectacular. But given the situation that we face moving forward, we think we need to strengthen Siloam 5.0 to the next level. And we come up with the NGS, Next Gen Siloam. This is where I'm very proud being part of Siloam, because most companies, when they don't see the strategy is broken, don't fix it. But Siloam sees things differently. This is forward-looking, right? Not many companies is really implementing a strategy on a forward-looking and persistently execute on that. But the way we built the strengthening of the strategy is based on 3 pillars. We believe with the scale that we have, 41 networks, 15,000 employees, people first have to be the first pillar, because we believe that this is where the strength of the company is. The next level of pillar that is going to change the landscape of how we operate is actually the supercharging archetype. I'll address some of the details on the next slides. And then the third pillar is how can we become beyond a hospital company or network player to become a healthcare integrated company. And that is going to be through pillar number 3, go beyond. But with this, the biggest difference is also this will put us in the map of Southeast Asia to become an impactful healthcare leader in Southeast Asia by enhancing capabilities and solidifying our competitive advantages, right? And I'll talk briefly on that later on the subsequent slides. But this Next Gen Siloam, if you will see this, is really going to be our strategy on the next level to continue becoming the best hospital network player in the country and the region, and to drive the breakthrough growth that we have been driving for the past 5 years. Next page, please. So people first is going to be a important element in how we drive our business. I'm only highlighting 2 aspects of the people first transformation that we are doing in Siloam. On the left, you see, because we are moving into the archetype, the objective is really to strengthen our leaders and our businesses that they can make decisions fast, empower the teams, instead of everything going back to head office, and how can we deliver on the operating models of being capable, making sure the resources and how we run the business is aligned. And the outcome was obviously very clear. It has to go back to the archetype where they can execute and deliver on the performance that we want. So to achieve this, we have started engaging the world best consultant, and today it's called the Project Excellence Team, and you can see on the timeline below of where we are today and how we're gonna achieve this by end of 2025. On the right-hand side, which is equally important, is nursing transformation. As you can understand that running a hospital network, the capability and competency of nurse is so critical, because nurse is in the ward, in the operating theater, in the ICUs, and all the skill sets are different, right? And this is where we want to make sure that we will have that quality to deliver the outcome on our hospitals. Next page, please. So archetype. So this is, I would say, the biggest differentiator of how we run our business. If you have been following Siloam for all these years, you understand that the way we run our hospital network is through regional cut. We had 5 different regions, and every region is clubbing or making the hospital units according to its geographic location. So within each region, we have a mix between the premium side, the medium type of hospital, and the universal healthcare coverage hospital. The challenge with running this regional cut moving forward is 2 things. Indonesia has challenges of doctors availability and also how we can manage our costs and the behavior of our patients across the country. So we believe if we do not shift from regional to archetype, the growth of where we want to deliver is going to be capped. So with the archetype, we basically have 4 different segmentation. One is premium specialist, one is premium generalist, one is value seeker, and one is community generalist, which is the BPJS. So in the past, when the regional heads are running the business, if they have a lot of case mix between BPJS or the affordable healthcare, they try to move the hospital to the next level of premium. And this is where the hindrance of growth is starting to happen. Today, with 4 different archetypes, if you are a value seeker, which is affordable healthcare network, all you do is just focus on making sure we deliver on the affordable healthcare without bells and whistles. If you are a BPJS or community generalist archetype hospital network, you continue to run your volume and run it like a factory and manage your costs. On the premium side, the same way. So this is where it's a huge shift of running our hospital networks to the next level. But one thing you keep in mind, among all the 4 archetypes, the only thing that we do not compromise is patient outcome through our clinical program. So how can we do this? So we shift the mindset. So that's why when you look into the leadership of the archetype organization, we have the people with the right mindset, right? We have 4 different leaders. Dr. Susi, who's been so ingrained into specialty and she knows this, and Dr. Hans in the premium for generalist is the right person, and Ibu Dewi has been running our affordable platform, and Dr. Irwan is for the BPJS. But one thing that we learned, we have started implementing this back in December 2024, and it was a complete switch from a regional to an archetype run operation. So the 5-year roadmap is very clear on where we want to go. Again, one of the other benefit that we see of doing this 4 different type of archetypes, especially through our premium archetype, it will put us in the map of Southeast Asia, because with the premium specialists, which is focusing into 1 or 2 center of excellence, I'll name you a few. For example, MRCCC in the center of Jakarta is one of the best cancer center in Southeast Asia. It's probably the best in Indonesia. And then in Siloam Asri, which is the best kidney transplant, it will put us in the map of Southeast Asia, allowing Indonesian especially to have the option of not going overseas for medical treatment. So with the premium side, credibility for us and through accreditation is going to be the proof that Siloam will deliver quality outcome for treatment. And then for moving forward, we spend all the investments through CapEx, and we make sure the implementation of clinical program and patient outcome is carried out well, and according to all the timeline, so far we have been on track, or we are ahead of the curve. Next page, please. So the third pillar is actually go beyond. I briefly touched on the point that Siloam today is evolving from a hospital network player to become an integrated healthcare player. And for that, we also want to look for the new source of growth. And this will be clubbed under the Go Beyond. So basically, this is really expanding into the adjacencies of businesses that we have. And if you can look into the right-hand side, it's ambulatory care that we are expanding, personalized medicine, biotechnology, and definitely we implement artificial intelligence. But at the end, this whole integrated healthcare company is becoming the healthcare ecosystem for Indonesia, and hopefully we will also penetrate into the region. With that, I hope you guys are very clear on the direction that we will take for the next 5 years, starting at 2024, 2025 to 2029. But what we are looking today, since we have implemented this late last year, we see the trend is really reflecting on the growth and what we believe is going to be a breakthrough for Siloam. Back to you, Ibu Caroline. Thank you.
Thank you very much, David. So as you can see, NGS is a big focus for the management. We are very optimistic about the growth potential in the healthcare industry in Indonesia over the next few years and the next decade to come. And we believe that NGS will be providing us with that next S-curve, as David has already mentioned. I'd like to give you a few business updates. I have 5 to be exact. Let's start with the first one. We will be installing the first Da Vinci Xi surgical robot in Siloam, and it will be the first in Indonesia as well. It will be installed in the next few weeks. Robotics is the future of minimal invasive surgery, and the Da Vinci is the Mercedes-Benz of surgical robots. Robotic surgery provides surgeons with better precision, visualization, and movement range during surgery, especially in more complex surgeries such as prostate biopsy, prostatectomies and prostate biopsies, leading to better patient outcomes that can be seen in lower complication rates, faster recovery, shorter hospital stay, etc. The reason that we have chosen to do this is that it supports the amazing surgeons that we have at Siloam, and you can only do robotics if you have a very strong surgical team. It supports the development of our clinical programs, which has been a focus for always. It elevates patient care to global standards and raises the level of acuity to a different level. Developments of capabilities such as robotics also does raise the RPOB over time. And so this absolutely makes sense for Siloam to do, and we will be installing in Siloam, Kebon Jeruk. So that's something exciting that we're all looking forward to. The next that I would like to share is on the clinical research division that we have. The clinical trials and research operations is something that we've been incubating for the past 4 years, and we have seen exponential growth in the past few quarters, and that's why we're finally sharing this with you. Participating in industry-sponsored trials has many benefits. 1, it supports global efforts in the development of novel drugs and treatments. Number 2, it provides patients with early access to advanced evidence-based precision care to patients in Indonesia. Industry-sponsored also means that patients do not pay to participate in these trials. So it also helps with affordability. By working with clinical research organizations and sponsors, it challenges Siloam to a different level of quality and care. We work with 4 out of the top 5 clinical research organizations globally, and 75% of the partners we work with are global players. Number 4, it supports our centers of excellences. And number 5, it is a sustainable and profitable business. Globally, it is a multi-billion-dollar industry, and we see tremendous potential for growth in Indonesia. Siloam is in a unique position to be doing this because of our large network, because of our large patient base, and because of our advanced clinical capabilities. So I've included here 2 examples of trials that we're doing currently. One is immunotherapy for metastatic colorectal cancer. And the second one is PSMA for SPECT scanning, imaging diagnostics for prostate cancer patients. And both of these are being done at our MRCCC Oncology Center. The next exciting project that I would like to share with you is about the use of artificial intelligence. So how are we making the best out of the opportunities in AI? The possibilities for AI in hospital operations are endless. We are starting with a few projects, and these are 2 very promising projects that I'm sharing with you today. The first one is AI for medical notes. This is where you will see a shift in behavior in our doctors and soon to be staff as well. So if you come to Siloam 10 years ago, then you will see our doctors writing in files. If you come to Siloam now, most likely you will see our doctors typing in the medical records. Well, with AI, what the AI does is that it records the conversation between the doctor and the patient, it transcribes, and it fills out the SOAP notes in our medical records. And therefore, there are many benefits to it. It frees up the doctor from typing, can focus on the patient, and it also gives us more accurate and complete data in our EMR. And so data quality is also better that we can then use to do further analysis and improve patient care from that. So there's an efficiency aspect to it. There is also a quality improvement aspect to it. And there's also a patient care aspect to it because the doctor is focusing on the patient and not focusing on typing in the EMR. The second one is AI for inventory management, because we have a large supply chain operations. We've made a lot of improvement in working capital days, I hope that you'll notice. And a lot of which is due to the improvement of days of inventory that has reduced from 52 days to 24 days. Now, we want to optimize this further. We know that there are opportunities. We'll be using AI to further improve inventory management. For example, using AI to determine min-max levels, using AI vision to detect inventory quantities, batch numbers, expiry dates. And so therefore, this will increase the accuracy of our inventory management and also reduce workload. And so there is a savings through this whole process. The next one I'd like to update is, as always, we like to share with you what to expect in terms of pipeline. We continue to expand our network. We have shared our plans for expansion in existing hospitals this year, which is Makassar, Surabaya, Gubeng, and LV Oncology Center. These things should not be new because we've been sharing over the past few quarters. And these projects are on track. Surabaya City of Tomorrow, or Surabaya Sito, will be open in Q4 of this year, finally, and this will be a new location, our second location in Surabaya. 2026 pipeline includes extension of our transplant center, Siloam Asri, and today we will also be sharing for the first time our projects to convert our clinics in Ubud and Canggu to become full hospitals as a part of our Bali strategy. We will be growing our beds by 10% in 2025 and 16% in 2026. Please correct me if I am wrong, if those are the numbers. I think those are the numbers. And this is also solidifying our commitment for future growth. The next update, please, to the last update is on ESG, something that I'm sure all of you are have also very close to heart. We are so proud to be sharing that we are in the top 21% for sustainability out of all companies assessed globally by EcoVadis. And so, as you can imagine, this is not something easy for us to achieve. This demonstrates our commitment to sustainability. The improvement made is based on the ESG framework that I have shared with you in previous earnings calls, which we have been very deliberate about and really focusing as an organization on how we want to do better. So this is a whole organizational effort in order for us to move the needle as much as we have in 2024. And so as you can see, the progress that we have made in 2024, we increased 18 points, which is an incredible leap for 1 year. And you can see that we have made incredible progress, not just in the consolidated points, but also in every single category. We have made tremendous progress. And so we're very proud of the team for pulling this through. So this wraps up the highlights on business and operations. They're just some highlights of the many things we're doing at Siloam to raise the bar of clinical care and quality in Indonesia. It is consistent with the Siloam vision, the Siloam strategy, and commitment to drive sustainable and profitable growth. So with that, I think that's a good segue for us to move into our financials. So over to you, Daniel.
Thank you, Carol. Financials for 2024, I would say that it has been a stable year, despite, as most of you would know, a challenging macro environment, along with pressures, from the insurance segments. Revenue for Siloam grew 9.1% to hit 9.45 trillion at the end of 2024. Underlying EBITDA is slightly flatter at 2.76 trillion, an increase of 3.2%. Now, some of this is due to some of the expenses, one-off that was included towards the end of the year for the purpose of transformation, which I will go into in further details. That basically leads to a underlying net profit that is not very different to the year before at 1.26 trillion. But I think it's important to highlight in this view in that the operating cash flow has improved year on year by over 10%, 11.1%. That is due to various fiscal measures that management has taken to look at inventory days along with AR and AP days. We do believe that, especially with a highly uncertain macroeconomic environment going forward, the ability to manage working capital and cash flow better is going to be paramount to ensure that the continued business operations and the execution of the Siloam NGS strategy is not affected. Next. In regard to the payer mix, you will see that the corporate and insurance segment has in fact improved from FY2024 to FY2023. In FY2023, the corporate insurance segment contributed 49.2% of total revenue, and in FY2024, that improved to 49.8%. You can see from the bottom chart is telling a similar story, whereby the growth in corporate insurance over the years has also been the strongest compared to both private and BPJS, whereby corporate insurance grew by a CAGR of 22.1% over the last 5 years, and BPJS by 6% and OPE by 10.5%. Similar trend as you can see on the Q4 results, whereby Y-on-Y, 4Q to 4Q, corporate insurance grew by 11.6%, whereas OPE only grew by 1% and BPJS actually fell by 5.1%. I think this is a testament to the fact that we believe the corporate and insurance segments is stabilizing. The way we look at the corporate and insurance sectors is generally divided into 4 groups. There is obviously the corporate segment, there is the individual insurance, there is the group insurance, and there is the international insurance. As I previously alluded to in the earlier earning calls, Siloam's strategy has been to be harder on our negotiation in regard to discounts that's been requested by the insurance players. But that is largely due to our ability to command I believe, better pricing in line with the strategy that we have executed in the past, whereby we now have the widest network in Indonesia compared to anyone else, and also we have the most complete suite of services, along with certain complex services whereby it would be difficult to get at any other hospitals. So I think those strategic advantage allow us to command a better pricing. I'm pleased to report that a lot of those discussions and on discount have recently been completed, especially for more of our major players. And for the last 5 to 6 months, we have seen that the corporate insurance segment as a whole been seeing positive month-on-month improvement over the last 5 to 6 months, whereas before that it was still a bit volatile from month to month. So I think with 5 to 6 months of continuous month-on-month improvement, this indicates that the corporate insurance sectors is now going back to a stable platform of growth. And we do look forward to a continued partnership with our corporate insurance customers to be able to continue growing the healthcare segment in Indonesia. Next. The revenue intensity, as I alluded to earlier, has always been a key pillar, cornerstone of the strategy from Siloam. And as you can see, that has continued to improve from 3.33 in the 2023 up to 3.43 in the 2024. The quarterly ARPOC has also improved from 0.82 in first Q of 2024 to 0.89 in 4Q of 2024, whilst it has stayed relatively stable from 3Q to 4Q of this year. Next. The throughput, I think, is in line with what you're seeing in revenue. On a year-on-year basis, outpatients, inpatients, and so forth has improved by generally about 7%. With the Q-on-Q performances for 3Q to 4Q is relatively flat, and that is largely due to lower productive days. I mean, 4Q is generally a softer quarter due to holidays and year-end leaves and so forth. But otherwise, as you can see, year-on-year throughput reflects the revenue performance of around 7%. Next. One important point to highlight in regard to the OPEX is that in 4Q 2024, you would have noticed that OPEX has increased, which is correct. I do want to highlight on some of the reasons for the increase that happened in 4Q 2024. I mean, first of all, there was a 25B that was incurred for the implementations of the MESOP management employee share options program that we believe is important to align the management interests with that of shareholders. Now, keep in mind that the MESOP program has no cash impact. Yeah, the way the MESOP works is that we are not implementing the MESOP by issuing new shares. Siloam basically purchased about 50B worth of shares, I mean, from the market over a number of periods as treasury shares. And the average price of the share purchase is offered to management as the strike price for the MESOP. So in other words, if management was to execute and exercise all their options completely, Siloam will get back exactly what Siloam paid to purchase those treasury shares in the first place. So net, there is no cash impact on performances, but accounting-wise, accounting does require the expenses to be captured. Now, when the way the PSAK structure works is that when these shares are purchased or exercised by management, the exercise price will go straight to retained earnings. So retained earnings, whilst it will show initially an expense from the implementation of MESOP, it will be cancelled out when this MESOP are exercised. So net, there's really no cash impact on Siloam's performances. There were another 32B that were invested towards Q4. As you can see from what David has presented earlier, the NGS transformation is substantial. It is not just a matter of putting on a sheet of paper to say that, oh, we are changing the classifications of certain hospitals. We are going through a whole workforce realignment to ensure that the structure of the organizations is appropriate to support the implementations of especially the archetype strategies. As a result, there were various expenditures incurred in Q4 for workforce realignment and also on the consultant research again, another pillar that Pak David has alluded to earlier is to go beyond, right? In looking for adjacent revenue opportunities. And these are important for us to do appropriate research in order to understand what is the size of the wallet that we can gain, what is the addressable market, what is the appropriate strategy to implement. As David mentioned, when the time comes closer, we will share with you more details. But we have done substantial research in Q4 in order to identify those industries that we should go into. Along with, obviously, as a part of the archetype implementations, we want to look at how we can improve our branding going forward, and there's various costs incurred for that. We do believe that these are investments that is important to drive the long-term growth for Siloam, and as a result, OPEX for Q4 was impacted. If you were to exclude those items, which is what I'm trying to show here with the underlying OPEX, you will see that the OPEX percentage would have been flat compared to the quarter before, stable at about 30.9%, which means that the overall OPEX for 2024 is also roughly stable compared to what it was in the year 2023. Moving on. In regard to other expense items, we continue to make improvements. For example, if you were to look at drug and clinical supplies, the percentage of revenue has steadily decreased. 2023 was 28.5% in 2024, and that has improved to 28.4%. We do expect that trend to continue. Operating expenses, as I alluded to earlier, 2024 is slightly higher compared to 2023 due to various one-off transformational expenses in Q4 2024. Once you normalize for those expenses, then the OPEX is relatively flat in 2024 compared to 2023. Now, same reason that drives a slight reductions in the underlying EBITDA margin. Again, to reiterate, the underlying EBITDA, the key differences is that we excluded the 200 B of a non-cash write-down that was carried out in 1Q of 2024, whereby we have decided, again, this we have disclosed to the market previously. This is basically the adjustment of hospitals that's been invested prior to 2019, for which we now have made a decision not to proceed. Again, these are all non-cash impact that has been adjusted out. Underlying net profit, similarly, would have been reduced slightly compared to 2023 as a result of this one-off. Otherwise, the margin would have been relatively flat compared to the year before. Next. Operating cash flow, again, I'm pleased to report, as you can see, over the last 5 years, it has seen a close to 30% year-on-year improvement. 23-24, I mean, that despite the EBITDA staying relatively flat, operating cash flow has in fact improved by over 11%. And we do expect this trend to continue, and for us to continue to find levers to improve inventory days, AR days, and also AP days. But in regard to investing cash flow, 2024, we spent 1.6 trillion. I think for 2025, we would be expected to spend roughly on the same amount, between 1.5 to 2 trillion dollars, depending on the investment opportunities that presents itself. Cash balance is at a very healthy 1 trillion rupiah as a result of, as I mentioned, prudent fiscal management that has been implemented in 2024. And the last slide I want to share with you is that most of you have already seen the announcements earlier this week, whereby Siloam has successfully negotiated and executed syndicated facilities with a value of 14.5 trillion on 24th of March 2025. Now, the purpose of this facility coming back is in line with the January announcements that you have seen, whereby we intend to purchase First REIT's 14 portfolio hospitals within 2025. Now, obviously, that will be subjected to various approvals, and negotiations is still underway. But I think the fact that we have been able to get this facility from a number of very reputable banks, as you can see in here, the lead bank is BNI and CIMB. But along with that, we have BCA, we have DBS, we have MUFG, we have HSBC as part of the syndications. I mean, this indicates, I believe, the banking sector believe in the financial strength of Siloam. Obviously,
voice was really a little muffled just for a few seconds there. I think, can you fix your mic maybe?
Okay, is this better? It's the same mic, so I'll just move a bit closer. With that, I end my presentations. I'll move on to Q&A for any questions. But if you can basically put your questions on the Q&A, we would then try to address them. Thank you.
In the interest of time, I'll answer the first question, Daniel. The question is, can you share the revenue breakdown according to the 4 archetypes currently and the target breakdown in 3 to 5 years' time? How will the shift in breakdown mean for margin? So generally, premium specialists and premium generalists contribute to 30% of the business each. And value seeker and community generalists contribute to 20% to the business each. That's roughly the breakdown. We are currently doing a road mapping exercise like David shared with you. And this road mapping exercise will be done for each and every hospital. We've started with 16 hospitals that we call the 16 pilot hospitals that we believe we have the biggest upside. Most of them are in the premium segment. I believe that there are 2 in value seeker, 2 from community generalist archetype. Now, we'll do this for all 41 hospitals. We will identify the key levers for each hospital, and that will also come with targets, occupied beds, operational beds, board targets, occupied beds, our pop targets, and of course, revenue and margin targets as well. And this will provide a margin uplift for each hospital and each archetype. So this is a mix. Thank you.
Let me answer the second questions. Look, obviously the impact on depreciations is not known at this stage because the negotiation is still underway in regard to the purchase price. But internally, we have done the various modeling. We do believe that on IRR basis, over a period of time, the impact to shareholders is positive as a result of the first REIT acquisitions. Now, a key reason for that I do want to outline is the fact that, look, if you've been following Siloam, you understand that the rental that Siloam pays is basically pegged to our revenue growth. It's a percentage of revenue. With the revenue growth that has been increasingly significant over the past few years, the rental has been going at the same rate. And therefore, we do expect rental increase to be higher going forward if we do not do the purchase back from first REIT. As a result of this, we do believe that over time, this will be earning accretive to Siloam, although obviously there will be certain timing differences initially depending on what the pricing that's negotiated in regards to the purchase.
Daniel, you want to answer the other question on the loan before we get to the question before that?
Yeah, sure. Let me answer so on the loan is on the rate of GBOR plus 1.45%. Yeah. So based on current GBOR, it's probably about 8.2%. But whether it will be drawn this year depends on obviously the negotiation with First REIT. But we do expect at this stage that the first REIT purchase should be concluded in 2025, but obviously that is subject to various negotiations, shareholders' approval on both sides. But we would not be drawing down the loan, obviously, until the deal has been agreed. In regard to the overall gearing ratio and so forth, again, it is too early to comment at this stage because the pricing has not been negotiated yet. But I think for the analyst that is here, you can obviously make some estimates based on the NAV book value that First REIT has currently disclosed in their books. But from Siloam perspective, we won't be able to give any specific numbers simply because the final price has not been agreed.
Okay. I think there's a question. There are 2 questions related to revenue intensity and RPOB, particularly in quarter 4. So I think to that, the first point would be that we should remember that Q4 is always a little bit of a lesser quarter because of the impact of December. The impact is twofold. One is there are less productive days in Q4 compared to Q3, but also generally people try to avoid Christmas, New Year, and scheduling elective surgeries. So there's always going to be, if you see every year, a slight decrease in Q4. But and therefore, if you look at full year, if you look at the RPOB increase, we have increased our RPOB from Q1 to Q4. And so there is a gradual increase, but if you compare to Q3 to Q4, you will also see this trend that there is a slight dip in RPOB, and that's because of the two factors that I've shared, and nothing else besides that. In terms of corporate insurance, I think Daniel has touched on it. So for corporate and insurance, we see that things are moving in the right direction. We have shared with you that in Q3 and Q4, we saw a lot of volatility, but we see that things are moving in the right direction, even though there is still a lot of moving parts and a lot of rebasing between corporate insurance, some corporates moving to insurance, some insurances closing down their corporate business and therefore moving to other insurances. The good news is we do see some accounts stabilizing and moving into growth trajectory. And there are a number of other accounts that are still going through the process of getting there. The number of cashless has also come back, and we continue with negotiations. Most of the negotiations have been settled and closed with discount rates and rebates that are acceptable. And we continue to work with insurances to build trust and transparency with both sides. And we think that while there still will be a lot of movement in 2025, but we think that we are moving on in the right direction. Daniel, you want to get the last question on?
So the traffic in 1Q 2025, again, maybe I should comment more on the last few weeks. I mean, we are seeing the volume improving over the last few weeks. Generally, I think you would expect that to be impacted by, there was an extra long weekend, but that was obviously over the Chinese New Year period. So that would have impacted throughput. But on the whole, I would say that over the last few weeks, obviously Q3 is not closed yet. Q1 of 2025 is not closed yet. But we are seeing a strong performance towards the second half of Q1 versus the first half of Q1. The rental amount paid for assets in first rate, again, that's in our financial statement. Each year, that's about 300-400 billion. Volume slowdown, I think Carol has answered that. In regard to productive days for 4Q.
Outbound medical tourism. There's a question about outbound medical tourism. Are we seeing an impact of that? I guess my answer is that this is not something new. I think Indonesians have been flying to Singapore and recently more to Malaysia and to Thailand for many, many years. But I think, I guess I'd like to ask this question in a different way, right? If MRCC did not exist in Indonesia, if ASRI did not exist, if a Siloam Lipo Village did not exist in Indonesia, would we see a higher influx of patients going overseas? Yeah, of course. I think that it is because that we have centers like LV, Kebonjeruk, MRCC, ASRI, that some people are considering doing treatment in Indonesia. And so what needs to be done, number one is we need to make sure we build up our capabilities. We need to build up our content. And that brings us back to Siloam 5.0 and what we've been doing in Siloam 5.0, and continuing on to the archetype project and being super focused in our premium hospitals in building clinical content and capabilities. And David's also explained that in the premium, some of the things that we're doing in order to do this is, number one, recruiting the best doctors, investing in cutting edge equipment, and building teams and programs in order to build patient care and quality to where global standards are. Only then we will retain outbound medical tourism. So again, it is not something new. I think over the years, it is something that Siloam has helped the country to fight against. And if we execute our archetype strategy properly, and we are successful, we will see more patients retain in Indonesia. And we have seen a lot of patients choose to do treatments in Indonesia instead of fly overseas.
And adding to that, actually, we are also seeing some indication of repatriating patients from overseas back to Siloam, right, with our premium sites. That's why in my earlier slide, I said that with this archetype through our premium sites, it's really going to put us in the map of Southeast Asia leader. So this is where, when Caroline said that this is where Siloam is going to go through the next level, building upon Siloam 5.0 with the next gen, we really believe that it will give Indonesians the option of not treating overseas. So they can be treated locally with the same or better outcome.
I want to answer this question around BPJS volumes dropping recently. Is it an industry trend or is it specific to Siloam? I think twofold. One, BPJS has been putting pressure on all hospitals across Indonesia and just making sure that there is generally better governance. And I think it is the right thing to do. Although implementation and execution, always room for improvement. But I think specific to Siloam, what I'd like to say is that by executing the archetype strategy, we have been able to move the payer mix. And so in one of our archetypes, and I'll share with you which archetype it is value seeker, we have moved the payer mix significantly by growing our non-BPJS and also putting better controls on BPJS as well. And so that has also led to double-digit EBITDA growth for that archetype. So I don't want to go into specifics, but I just want to share that, again, linking back to the archetype, this is something that is working. But if BPJS were to grow more in our community generalist archetype, would we stop it? No, we would not stop it, because it is the model, and by growing more volume in clinical community generalists, then that would improve the profitability and performance of that archetype. So is it deliberate? Yes, absolutely, it is deliberate. But yes, we are also seeing some pressure coming from BPJS as well.
Let me take Ingrid's questions. Ingrid, I think if you were to look at the first half of 2024 versus second half of 2024, one thing that's very important to highlight, I think, is that in the 2023, Siloam's came out of COVID, faster than everybody else. The growth in the 23, versus 22 was close to 30%. Yeah. And a lot of that basically happens towards the second half of 2023, but whereby the growth was quite significant. So, which is why when you look at kind of a second half of 24, YY versus the year before, it does look like the growth becomes smaller. That is again largely because we are comparing against a higher base. Yeah. But we did allude to earlier as well, in that at the start of the year, again, this is industry trend as well. Q1, generally speaking, has seasonality factors that help Q1 performances in 2024. So that has impacted that as well. But I think it's important to look at the second half performance in context of the high growth and high base that we're looking at in second half of 2023.
There is a question around BPJS. I think I answered that as well. So yes, there is pressure, but I think our teams have been done very well in going out and looking for other sources of referrals. So BPJS has been stricter with referrals, which again, I think it is the right thing to do. But you could benefit from it if you have services that other hospitals don't have. So in that case, then actually you can bypass certain referral layers in order for us to get patients. So it doesn't always work against us, the tightening of BPJS. BPJS itself, we think that they've said, and we have information from our friends in BPJS that 2025, 2026 should look okay. They've done their calculations. I think that they are becoming a lot more sophisticated in controlling fraud, in controlling costs, and monitoring outcomes and everything. And so we welcome that very positively. Over the mid to long term, there probably needs to be a little bit of restructuring. But I think that for now, I think they're doing their best, and 25 should be okay. We're not too worried for 2025. Coordination of benefits is, we see this as very positive. In fact, our value seeker archetype and our BPJS archetype have coordination of benefit as two big initiatives that they're going to do. Because there is a need for it and the doors have been opened for it. Regulation does allow for it, although there is some technical details to be worked out on the ground. But we think that if we can get this going, it will provide an upside for value seeker and community generalists. So we have set timelines and targets for us to go after coordination of benefit. And if we're successful, it will be an uplift. The single class would also be a good thing for us, but we have yet to see the tariffs of the single class, which have yet to be announced. And so depending on that, there may be a upside or otherwise. So the single class itself is a good thing, depending on where then the tariffs end up. Oh. Okay, CBC is a major shareholder. Well, CBC has been with an investor in Siloam for the past 8 years, and they have been very involved in the past 8 years as well. And so there's great alignment between CBC and the management team. The Next Gen Siloam strategy was something that we've brainstormed and come up with together, maybe 18 to 24 months before the transaction. It was not done in order to get the transaction through or in anticipation of the transaction, but really CVC and other shareholders and the management coming together and thinking about what is best for Siloam in the next 5 to 10 years. And therefore, you can see the degree of alignment there. We have, of course, the 3 pillars of the NGS. We also have VCPs that we have put together, and we monitor together, and we believe that this is the best for the company. And so there is a great alignment for between the management and CBC. Guidance for 2025. We would, normally we would give guidance, and usually we are quite consistent with the guidance that we give, but given the volatility in the macro market, the recovery that we are still watching in the payer market as well, just like we did during COVID, we are going to see how the first 2 quarters go, and then we will come back to you on guidance for the year, given that there are a lot of moving parts.
So let's conclude for our call for today. So thank you, Bu Caroline, Pak Daniel, and Pak David for your time. We'd also like to thank you to all participants who joined the call for today. Thank you and have a good day, everyone, and we'll see you on the next webinar. Thank you, Pak. Thank you, Bu.
Thank you.
Ready.